it's really tough to overemphasize the importance of a good management team. And to be it can be tough because any REIT CEO can look great on paper. I have never never read about a REIT CEO that did not have an impressive resume. That's why they became a CEO. They've either moved up through the ranks or they had great experience elsewhere. So it's really important to kind of look at, one, what their experience is like. Do they have a good track record or not? Most CEOs have had executive roles at REITs. How did those REITs perform when they were in those roles is one question to answer. Do these CEOs have a lot of skin in the game? When the pandemic hit and the market started going crazy in March, the CEOs that really believed in what they're doing and knew that this was a good long-term investment were buying their own stock hand over fist. We put out a report to Mogul members that just focused on all the CEOs that were buying their own stock, and it was pretty impressive. Some were putting millions of dollars of their own money at risk. You also want management teams that have a good history of working together. I know one of my favorite management teams has been working together for 25 years in various different roles, even at predecessor companies. So that's one thing to look at. And in a REITs, you can check this out on investor relations pages under the SEC filings. Look at the proxy statement, because that tells you how the executives get paid. You want to see REIT executives get paid with a lot of stock. You want them to have a lot of skin in the game, and you want them to be highly invested in their success. I have no issues in somebody getting rich if they're making shareholders rich as well.
You are listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth. Hello, I'm Deidre Woolard, an editor at Millionacres. Thank you so much for tuning in to the Millionacres Podcast. Today's podcast is a special episode that will feature Senior Analyst Matt Frankel sharing his system for evaluating real estate investment trusts step by step. Matt is a certified financial planner, and he's been a full contributor since 2012. A former mathematics professor, he's highly knowledgeable about all things finance, but has become one of the most knowledgeable people on the subject of REITs in our Motley Fool universe. In his work for our Millionacres premium services, Mogul and Real Estate Winners, he has shared his system for looking at REITs with members. And so today I asked him to give listeners a window into his thought process when he's choosing a new REIT to invest in or to recommend. So take it away, Matt.
Obviously, there's some parts of our analytical processes, especially in Mogul and Real Estate Winners, that are proprietary. But having said that, I love sharing my kind of thought process on REITs because it helps people really understand how these stocks work, how to evaluate them, what separates a bad from a good one. People always ask me, how long do I spend on REITs? And I can tell you how long I spend before I can identify a bad one. And that's like 10 seconds because of this analytical process. So normally by point 1 or 2, you can really tell which ones are worth further consideration. So with that in mind, I'm going to go through the points I look at when I consider a REIT, generally in order. Number 1, the first thing you should consider when you're considering buying a real estate investment trust is how long you plan to hold it for. Real estate investment trusts are best suited for long-term investors. Like any stock investment, they can be highly volatile. And a lot of times the volatility has very little to do with the company itself. We saw a lot of REITs that were doing just fine during the middle of the pandemic that were plunging. So stocks don't always behave rationally. The biggest downside, in my opinion, to REITs versus other types of real estate investment is that when you say buy an investment property, you don't have to constantly monitor the value of that investment. It doesn't change on a day-to-day basis. I have absolutely no idea how much the triplex I own downtown changed in value from last week. No idea. And I don't care. That's not why I own it. But with a REIT, which is a publicly traded stock, you really have to keep that in mind. So generally, I won't buy a REIT if I can't see myself holding it for a decade at least. That's not to say I will necessarily. But if I wouldn't want to own it for 10 years, I would not consider a REIT. Like I said, there are other options when it comes to real estate investing if you want to not have to worry about day-to-day price fluctuations, and if you have a shorter investment window. Crowdfunded commercial real estate's a new and exciting opportunity, just to name one example. And a lot of those have exit periods that are targeted within 3 to 5 years. If you have anything shorter than a 3-year investment window, don't invest in real estate. There are better vehicles for you. So that's number one, is kind of time frame. Provided that I'm comfortable holding whatever company I'm talking about for at least 10 years, I can move on to the next step with figuring out how does the REIT make its money. When we say REITs, we're talking generally about equity REITs, which are companies that own properties, as opposed to mortgage REITs, which are a whole different animal, and they're actually in the financial sector, not the real estate sector. They're that different. So with an equity REIT, the general idea is that the company owns commercial properties, leases them to tenants, and makes money. But it's not always quite that simple. Some REITs have other businesses. For example, to be a REIT, you only have to get 3/4 of your income from real estate. So some of my favorite REITs, for example, have entertainment businesses where they make money from things like ticket sales. So that's something else that's worth noting. Some REITs develop properties from the ground up. Some rely on being able to eventually sell those properties and kind of do a sort of what they call a capital recycling type of thing. So there are a few different ways that REITs can make money aside from just basic buy and hold, rent out your real estate investing. So that's step two. And the goal should be to be able to describe how a REIT makes its money in a couple of sentences. If you can't do that by just reading the REIT's annual report, then it's probably not a great investment for you. There's a reason I don't invest in many biotech stocks, for example, and it's because I don't understand what they do. And I can admit that, and that's fine. One of my favorite Warren Buffett quotes is that the size of your circle of competence doesn't really matter, but knowing its limits does. So the best way to interpret that is to only invest in businesses you understand well. And fortunately, many REITs are very easy to understand. But there are some with rather complex business models. Like I said, some have other businesses than real estate, some recycle capital. And if you don't understand really the dynamics of that, then you should probably try to focus on a REIT that you do understand. So after I understand what the REIT does, I want to figure out how it grows. One, is it in a market that has a lot of growth opportunity? I'll give you an example. In healthcare, there is about $1.5 trillion of healthcare real estate in the United States, and only about 15% of it is currently owned by REITs. A disproportionate amount is owned by the physicians that use them, the hospitals whose names are on them. So there's a lot of opportunity for acquisitions and consolidation within the existing healthcare industry. Plus, healthcare is a long-term growing market. The U.S. population is aging. The demographic trends favor healthcare growth over the long run. So that's number one. I want to know how a REIT's going to grow. And number two is actually how it's going to grow. Is it going to buy properties that already exist? Is it going to develop new properties? Is it going to do a combination of the two? Is it planning to recycle capital at an aggressive pace over time, which a lot of REITs do, and it can be a great way to create value if you do it correctly. So that's one thing. So development versus acquisition, and the reason I bring that up in particular is that there are two very different dynamics. Acquisition is designed to produce a stable revenue stream. You buy a property, especially if it already has tenants, and you're essentially buying that income stream. When you develop a property from a ground up, the goal is to not only create income, but to create value in the process. Just as a basic example, if you could build a property that's worth $1 million for $700,000, you've instantly created $300,000 in equity. It's not always that simple, and a lot of times properties end up costing more to develop than they would to just buy. So that's another thing that can be really great return generator if you do it right. So I'm not saying one's necessarily better than the other, but one, it's a key component of understanding how a REIT makes money, and it's a really key component of assessing risk. A REIT that grows primarily through development, all things being equal, will be more of a risky and volatile investment generally than a REIT that grows primarily through development. So I tend to gravitate toward REITs that do both. So that's the first three steps. The next thing I consider is where I'm going to own this REIT. REITs make excellent investments in IRAs and other tax-advantaged accounts. The reason is, as most people know, REITs pay above average dividends. That's one of the reasons a lot of people like investing in REITs. REITs are required to pay out at least 90% of their taxable income. Most pay even more. And they're great income stocks, but the caveat is REIT dividends can be very complicated for tax purposes. Their dividends generally don't qualify for what the IRS refers to as qualified dividend status, which gets you preferential tax rates. Essentially, it treats it like a long-term capital gain instead of ordinary income. So REITs generally don't qualify for that. And not only that, but REIT distributions generally are not made of all of one kind of income. At the end of the year, you'll get a dividend statement. You'll see that generally most of a REIT's dividend will be considered ordinary income. Some might be considered a qualified dividend, depending on how the REIT got the money to distribute. And some might be considered a non-taxable return of capital, which throws another little complication in there. That ordinarily happens if a REIT has sold properties at a profit and wants to distribute some of that money back to shareholders. So they can be quite complicated. And to complicate it more, this is complication in a good way, but REIT distributions generally qualify for that new, the 20%, what they call it, the pass-through tax deduction, because it's technically considered partnership income, kind of like if you've earned it from an LLC or something like that. So this is why I say REITs make great investments for IRAs, because then you don't have to worry about anything I just said. You can get your entire dividend, you can reinvest your entire dividend, you can let it compound until you retire, and that can really help the long-term compounding power of real estate. On the other hand, it's okay to buy shares in a taxable account. I generally put the REITs that pay relatively low dividends in my taxable account and prioritize the higher paying dividends for my IRA, or I have a solo 401k. It's okay to put REITs in a taxable brokerage account, but you want to understand how that works before you do that. So I definitely figure out what account I would potentially allocate the REIT to if I'm buying it for my own portfolio, not necessarily if I'm recommending it. Number 5, the management team. This is before I even look at any of the metrics of the business, I look at the management team. It's really tough to overstate the importance of great management, especially there are some types of REITs that essentially run themselves. I'd say like a self-storage REIT doesn't require a ton of expertise to make money. It's what Warren Buffett refers to as a ham sandwich business, a business so simple a ham sandwich could run it. But there are others, especially that involve a lot of development, a lot of capital recycling, things like that, where it's really important to have somebody who really knows what they're doing steering the ship. This has been the big difference between some of the retail REITs that are doing well and the retail REITs that have crumbled during the pandemic, or the hotel REITs that are doing well and have a really good game plan for after the pandemic, and those that are just kind of, moving along. So it's really tough to overemphasize the importance of a good management team. It can be tough because any REIT CEO can look great on paper. I have never never read about a REIT CEO that did not have an impressive resume. That's why they became a CEO. They've either moved up through the ranks or they had great experience elsewhere. So it's really important to kind of look at, one, what their experience is like. Do they have a good track record or not? Most CEOs have had executive roles at REITs. How did those REITs perform when they were in those roles is one question to answer. Do these CEOs have a lot of skin in the game? When the pandemic hit and the market started going crazy in March, the CEOs that really believed in what they're doing and knew that this was a good long-term investment were buying their own stock hand over fist. We put out a report to Mogul members that just focused on all the CEOs that were buying their own stock, and it was pretty impressive. Some were putting millions of dollars of their own money at risk. You also want management teams that have a good history of working together. I know one of my favorite management teams has been working together for 25 years in various different roles, even at predecessor companies. So that's one thing to look at. And in a REITs, you can check this out on investor relations pages under the SEC filings. Look at the proxy statement because that tells you how the executives get paid. You want to see REIT executives get paid with a lot of stock. You want them to have a lot of skin in the game, and you want them to be highly invested in their success. I have no issues in somebody getting rich if they're making shareholders rich as well. So that's one thing that you want to see. The skin in the game is kind of one big X factor for me. So having said that, let me move on to how we consider a REIT's finances. I don't want to get too mathematical. Deidre mentioned I used to be a mathematics professor, and as soon as I start talking about the real heavy mathematics of analysis, I can sense 80% of my listeners tuning out. So a few things to look at. The first metric you should know while you're evaluating a REIT is called funds from operations, or FFO. Think of this as earnings when in a traditional stock sense. Without getting too heavy into the tax treatment of real estate, earnings or net income is not a great measure of how much money a REIT is actually earning. That's where FFO comes in. It makes some real estate specific adjustments to give a better picture of how much profit a REIT is actually earning and therefore has available to pay dividends to shareholders and support its growth without having to issue too much more stock and things like that. So FFO is the key metric to look at when you're looking at a REIT's earnings growth rate. Don't pay attention to net income. That's a very common misconception, especially among new REIT investors. They'll say, oh, this REIT's had negative net income for the past 4 quarters. Why would I ever want to invest in that? And the answer is, if you own investment properties, you know very well it's really easy to make your income look negative in real estate if it's actually positive. So FFO is kind of it levels the playing field between earnings in REITs and earnings in the rest of the stock market. If you want to look at the valuation, for example, don't use the price to earnings, use the price to FFO ratio. If you want to look at growth rates, don't look at earnings growth rates, look at the FFO growth rates. A lot of REITs have their own FFO metrics. They call them like adjusted FFO, core FFO. Those aren't standardized, but they generally give you a picture of how a REIT is doing at any particular moment. So FFO, number one metric for REIT investors to know. Going beyond that, you want to look at some other financial aspects of the REIT. Liquidity is a big one. I mentioned considering how a REIT grows, but it's also equally important to consider how a REIT is going to fund its growth. Does a REIT have a big credit line, which a lot of the really good ones do? Does a REIT have a lot of debt outstanding? The debt to total capitalization ratio is a popular metric among REIT investors, especially how much of the total market cap is made up of debt. I generally like to see this at 50% or lower, but that's flexible depending on the situation and how much I like the rest of everything about the company. But generally a debt to capital is, in other words, if a REIT's market cap is $2 billion, I want its debt to be $2 billion or less. So that would be a total capitalization in that case would be $4 billion and debt would make up half of it. So that's a quick metric that you can calculate that can kind of give you, an idea of how much debt a REIT has. And what I will say about debt ratios, whether you use debt to capitalization, interest coverage ratio, things like that, they're really most useful for comparing REITs in the same type of subsector. For example, right now, it wouldn't be fair to compare the debt levels of a retail REIT with a communications REIT, for example. It's not really an apples to apples comparison. So you want to consider how a REIT compares to its peers when you want to see, does it have too much debt? Does it have enough liquidity? All things being equal, a REIT that has $1 billion of liquidity and a REIT that has $200 million of liquidity are two different things, especially when it comes to funding future opportunities. This is especially important in today's market. I'll get into what I'm specifically looking at this year in a bit, but liquidity allows REITs to take advantage of opportunities as they come up without having to try to find financing or sell stock or anything like that. If you have a credit line and an opportunity comes on the market to buy a property at an attractive price, liquidity lets you do that. So liquidity and debt, and a REIT's credit rating is something that a lot of people overlook. A lot of REITs boast about having investment grade credit ratings, which is good, but it's also important to note that there's a lot of different levels of credit when it comes to corporate debt. I'm not sure the exact number off the top of my head, and I don't want to sound silly by quoting the wrong number, but it's a lot. There are at least, I want to say at least 10 different levels of investment grade credit, or give or take. So better credit lets a REIT borrow money cheaply. Not only gives it access to more ability to borrow, but it gives it usually lower interest rates than other competitors, which can be a major competitive advantage. If two REITs each have $5 billion in debt, one is paying an average of 6% interest on its debt and one's paying an average of 3% interest. That's a big competitive cost advantage for the one that's paying a lower interest rate. So the interest it's paying on its debt also comes into play. It's not just the size of the debt. That's why we say a $20,000 auto loan is better than $10,000 of credit card debt, because you're going to be paying less interest on it. So same thing applies in the corporate world.
That's a great place to take a break. We hope you're enjoying this and every episode of the Millionacres Podcast. If you have a moment, we'd love to hear from you. Please visit millionacrespodcast.fool.com and tell us what you think of the podcast so far, what kind of content and guests you'd like to hear, and what else we can do to help you grow smarter, happier, and richer through real estate. We are back with Matt Frankel sharing thoughts on what an investor needs to know before deciding to purchase a REIT.
So now we'll get into the fun part. What specifically in 2020 are we looking for when it comes to REIT analysis? We are looking for, I mentioned, lots of liquidity, especially in the troubled sectors. Think hotels, retail, hospitality. These are offices are another one. These are areas where not only do you want to see a lot of liquidity to be able to make it through the tough times, because a lot of them are losing money right now, but you also want to see a lot of liquidity to take advantage of opportunities. I'll just name one example. One of our favorite hotel REITs is Ryman Hospitality Properties. I'm sure Deidre is sick of me talking about it at this point. But Ryman, they have a ton of liquidity. They've enough to last 30 months at the current loss rate. Their business is terrible right now, but they have enough liquidity for 30 months, which is great. And that lets them take advantage of the downtime. They kept their National Harbor property closed because it wouldn't have anyone in it. So they're taking advantage of that and renovating the rooms at this time. So when they emerge from the pandemic on the other side, those rooms will have more pricing power because they had the money to take advantage of what was going on right now. Some office REITs are actively looking to make acquisitions while the sector's so beaten down, and a lot of liquidity lets you do that. In 2020 specifically, quality matters more than anything. That's in terms of management. That's in terms of balance sheet, which we already talked about. It's also in terms of the assets themselves. We just saw two big mall REITs go bankrupt, very, very publicly. CBL and Associates was the really bad one. Pennsylvania Real Estate Investment Trust was the other, which looks like it's going to emerge pretty quickly. But those had what you call B-class and C-class mall properties. Meanwhile, there are no A-class mall operators that I know of that are in danger of going bankrupt anytime soon. They all, possible exception of one, but like Simon Property Group, A-class malls, best in the business. They have great assets. That makes a big difference. Ryman, which we just mentioned, has some of the most iconic landmark hotels in their respective markets. The Gaylord National Harbor is the landmark that most people identify the National Harbor by. I was talking to a friend about it. He said, "Oh, that's where the Gaylord is." So having iconic and irreplaceable and best-in-class assets really makes a difference, not only during the pandemic, but during all tough times. These assets tend to hold up better during normal recessions, like the financial crisis. So you also want to look at a few different variables. I like non-cyclical tenants, which is a good kind of recession-proof thing to focus on if you want something a little bit safer. I mentioned healthcare earlier. Healthcare is probably the least cyclical type of real estate. You should at least know the cyclicality of your investment, especially right now. Healthcare is something you need. It's something that tenants sign long-term leases. Doctors' offices don't move every 2 years on average. They generally stay in one. Their hospitals generally stay in the same place. So it's a very non-cyclical business. On the other hand, something like a hotel is a very cyclical business. So that's something you want to incorporate in your analysis as well. I mean, a very cyclical business at the right price could be a great investment, but it's definitely something you want to consider. You want to look at the types of tenants you have is another thing I'm looking at when I evaluate REITs. Think of the retail industry. I mentioned malls. Malls have a certain type of tenant for the most part. They have retailers that sell discretionary products, meaning things that people don't really need, and generally at full retail. I mean, most stores, like you go into the Gap, they have a sale rack, but it's generally considered a full price retailer. On the other hand, when you look at some of the REITs that invest in freestanding retail properties that specifically focus on things like drugstores and warehouse clubs and restaurants, these are things that are not very disruptable by e-commerce and not really struggling right now. So there could be a lot of variation within each subsector of real estate among the types of tenants. So don't just say, oh, all hotels are the same. We mentioned Ryman. They focus on group events like conventions and massive gatherings of people. Whereas, hotel operators that focus on extended stay hotels are generally focusing on leisure travel and business travel. Just one person traveling, not a giant group. So a big different dynamic there in what's going on now. Leisure travel has rebounded much faster than business travel, which has made not all hotels in the same position right now. Meanwhile, group events are not a thing. Who knows when we'll have another actual in-person conference. So that's one thing to really keep in mind. And lease length is another variable. You can have a non-cyclical business, but if tenants are allowed to leave every year or have to renew apartments are a non-cyclical business. People need places to live. It's an essential item, but the average apartment only leases for a year. So tenants, if they run into tough times, can vacate the property pretty easily. They have to wait till the end of their lease, but they can get out if they want a cheaper apartment or something like that. Whereas, say, an office tenant, it just is non-cyclical. That's something a company needs in general, for the most part. And, not some of the tech giants, but a normal company would need a physical office space. And that's something that you would sign a 10 to 15-year lease on at a minimum. So if a company signs a lease on an office, 3 years down the road, they say, we don't really need this much office space. They're locked in for another decade or so. So that's something else to consider when you're thinking about the type of tenants a REIT has in its portfolio. So now let's put all this together. Let's look at an example of, and we'll give you a little bonus right here. This is one stock that we recommend to members. It's called Healthpeak Properties. Healthpeak, ticker symbol is PEAK. And why I picked it to recommend to Real Estate Winners members instead of some of our other favorite healthcare REITs. So one, we said healthcare is a non-cyclical stock. And given the time we're in, that's important. If you can get a good deal on a non-cyclical, non-unstable business, then it could be a great way to go. How does it make its money? It grows through a combination of development and acquisition, which is a really nice thing to see. A lot of healthcare REITs especially grow just by acquisition. One of our favorite other healthcare REITs is a medical office REIT that primarily grows by just acquiring other properties. I don't think they've ever developed a property on their own. And Healthpeak has a record of doing it well and making money doing that. So that combination really helped. They have a ton of liquidity. Speaking of their growth and development, ambitions, they have $2.6 billion of liquidity right now. They have an investment grade credit rating, a strong balance sheet. They can borrow money pretty cheaply. So that's also an attractive quality relative to some of their peers. And the big thing is that they were diversified. When I talked about in the last point, what are their tenants? What do their tenants look like? A lot of REITs that specialize in healthcare just invest in medical offices. Some invest in just hospital properties. Some invest in just senior housing facilities. Healthpeak takes a more diverse approach, and that's one of the things I like the most about the stock. As far as a stable, predictable type of asset, medical offices are my favorite type of healthcare real estate. That makes up about a third of their property. Senior housing has probably the most long-term growth potential. The population's aging quickly. The 85 and older segment of the population is expected to roughly triple over the next 20 years. So that will be a big catalyst for senior housing eventually. It's a shaky industry right now with COVID going on. No one's moving their older relatives into senior housing facilities right now, and who knows how long that's going to last. So they only put 1/3 of their money roughly into that. A lot of growth potential, but it's shaky in the meantime. Then the other third they put into life science properties, which are kind of a really new and exciting type of way to invest in healthcare that is really rare for some of these big healthcare REITs to really have their hands in. And that's where they're actually doing most of their development activity. So I love the life science space. I think not only with the COVID vaccines and whatnot, but with the aging population, there's going to be a huge demand for that going forward. Most of them are located. Most life science companies are located in really high barrier markets. Think the Silicon Valley area, for example, which is where a lot of HealthPeak's properties are, and it's a great all around healthcare REIT. And after going through my kind of thought process here, and I'll spare you the analytical behind the scenes stuff that I do. But after going through all that, I crunched some of the numbers, and it's still trading at a pretty attractive valuation. Most healthcare REITs, especially medical office REITs, I mentioned that's my favorite type of healthcare. Those have rebounded to where they're almost at record highs right now. HealthPeak, because of their senior housing exposure, they're still trading at a pretty attractive valuation. They have exposure to all the types of healthcare assets I like. They have tons of liquidity to grow. The management team's fantastic. That's the one thing I didn't mention yet, but their management team has a ton of experience. They actually got a few of their managers from the Welltower, which is the biggest player in the sector. The management team's done a great job of kind of transforming the company into a rock solid, great balance sheet company over the past few years. And it after going through the process, it just looked really attractive relative to the other healthcare REITs. So hopefully that gives you a little bit of insight without giving too much away, but there's a freebie for you.
Awesome. Thank you. Thank you for all of that, Matt. I feel like we all have a better understanding of how to think about REIT investments. Was wondering if I could ask you just a couple of questions.
Sure.
So you mentioned recycling capital earlier. Could you explain a little bit what that means and how you should look at that if you're investing in REITs?
Sure. So let's say an apartment operator develops a brand new apartment community from the ground up in an urban area. They spend $50 million to do this, and when they're done, it's worth $80 million. They lease it up, fill it with tenants, stabilize the occupancy, and then they might decide to sell it and use that money to develop yet another property where they feel that the money could be put to better use for their shareholders. So that's just a basic hypothetical example, but it generally refers to taking mature properties and selling them at a profit and using that capital in a way that is likely to generate an even better return for shareholders. It's generally like, instead of just being satisfied with building a property and making 6% of your investment on rent, it's continuously trying to parlay that into bigger and bigger income streams over time.
Nice. So one other question. How do you feel about a REIT buying back its stock? So you mentioned that during the beginning of the pandemic that CEOs were buying back stock, but is it different when the company itself is buying stock?
Yeah, and that's a great question, especially in the context of REITs. Buybacks are very common in other types of stocks. They're not very common in the real estate world. Generally, because REITs are required to pay out most of their income to shareholders, generally they fund their growth through issuing new stocks. So they do the exact opposite of buybacks in most cases. Some of my favorite REITs issue billions of dollars of new stock every year. So when a REIT buys back its stock, it's really sending the message that management thinks that the stock is cheap and that is the best use of the company's money at the time. There are very few REITs that regularly buy back stock. Empire State Realty Trust is one of my favorite ones. And they are buying back stock hand over fist right now. They've had a $500 million buyback authorization for years and have never used it until 2020. Realty Income, one of my favorite REITs, does the opposite. They continually issue new stock to pay for properties. The idea is that they're going to issue stock, raise money, and then buy properties at favorable costs to increase shareholder value. They'll rarely buy back stock in the real estate world. So when a non-REIT buys back stock, I tend to take it with a grain of salt, just because that's a pretty standard business practice elsewhere in the business world. But in real estate, it's really not. So I tend to put a little more weight on that when a REIT buys back its own stock.
Interesting. Thank you. So final question. You mentioned you decide not to invest in something or not to recommend something pretty quickly. But when you're deciding the other way, how long does that take? And also, I was curious, how do you track your investments? Are you a journaler? Do you use Google Docs or spreadsheets? What's your system?
I use spreadsheets. I have a massive spreadsheet that has pretty much everything that I need to do my job. That's how I track everything from how I'm evaluating stocks to what's on my list right now to what articles I still have to write to, everything. So I'm a spreadsheet guy. That's how I kind of learned how to organize myself when I was very young. My dad was a computer engineer back in the 80s and taught me how spreadsheets worked really early. So that's kind of stuck with me the rest of my life. But when it comes to how much time I spend, and keep in mind that I do this for a living and I have a lot of practice, so I'm pretty efficient. I would say when I'm researching an investment, like let's say we're figuring out what pick to make next month for real estate winners, I'd say that the whole process, because we maintain such an organized watch list and stuff, takes me a couple hours. Having said that, if I'm looking at my watch list, which usually has about 50 different possibilities on it, I can usually go through them pretty quickly and eliminate about 40 of them really quickly. Like I said, I could say, this one I don't like what their management did last week. This one I'm not really, I don't like the growth they put up last quarter. I wish they would have spent more money on development, things like that. So there's like a fatal flaw with a lot of them for me that kind of scratches them off my list. And then once I narrow it down and decide kind of what subsector I want to go, like I mentioned healthcare, the Health Peak one, I knew I wanted a healthcare REIT. So that narrowed it down to, 5 or 6 that I really like out of the healthcare space. Once I get to that point, I'll read through their latest conference call. I'll read their latest annual report. I'll look at, they usually have, REITs are really good about having a great investor presentation on their website. If you don't want to sift through an annual report, which I get that not everybody's me and not everyone likes doing that. The investor presentations are usually very reader friendly and can really give you a great idea of what the business does. So that's one thing. Great stats. It'll show you the growth trends and things like that. Keep in mind that these investor decks are made by the management teams themselves, so take them with a grain of salt. They're not independent research. But having said that, I'll read those few things, then I will kind of crunch a few of the numbers, see where the valuation compares to their peers. I have my own kind of proprietary formula of how I estimate a REIT's asset value. So I want to see if a REIT's trading for a premium or discount to its asset value, compare that to the other ones on my list. So I'd say, like I said, I'd say I spend a couple hours making my next recommendation, and then that doesn't include actually writing it up. So that's just the analytical process.
Well, I would say it's a lot more than a couple hours, because it just from what you described, it's really sort of an evolving process.
Oh, right. I mean, I'm sure the spreadsheet has taken me hundreds of hours to actually put together. So it's, 2 hours on top of that.
Exactly. Well, thank you so much for this today. It was really great to hear more about how the Real Estate Winners team kind of thinks about REITs in general. And just a reminder for listeners, you can learn more about Matt's work on Millionacres, and you can also learn more about Real Estate Winners. Thank you.
Of course. I'm happy to be here.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. And if you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss, and Millionacres or The Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.